Welcome back to the Deep Dive. Today we're jumping into something that, let's be honest, can feel pretty intimidating.
Yeah,
The
definitely.
Alternative Minimum Tax,
Yeah.
AMT. You hear the acronym, maybe you see a line on a form, but what is it, really?
Exactly.
So our mission today is basically to cut through all that complexity. We want to give you the essentials, what it is, why it's even a thing, and, how it might actually be impacting your finances maybe without you realizing it.
Mm-hmm.
We've waded through some pretty dense material instructor guides for tax textbooks, that kind of thing, to really boil it down for you.
And it's important stuff. The AMT, it's not just some obscure rule for tax pros. It's woven into the fabric of the tax system, really aimed at fairness, believe it or not.
Fairness, okay. Interesting starting point.
It can seem like a monster, but understanding the why and the how, well, it can really change how you approach your taxes.
Okay, let's start right there then. The why. Why do we even have this thing called an alternative minimum tax? What problem was Congress trying to fix?
Yeah, good question. It really came about because people noticed, it became quite public, that some individuals with really significant economic income,
Making a lot of money.
right, making plenty of money, but they were using all sorts of perfectly legal deductions and exclusions and credits.
Loopholes, essentially, or just features.
Let's call them features that allowed them to pay very little or sometimes even zero income tax. So there was this feeling of, hey, that's not quite right.
Yeah, I could see how that would seem unfair.
Exactly. So the AMT was created as a sort of backstop to make sure that taxpayers earning above a certain level, with decent economic income, pay at least some minimum amount of tax.
Okay, a minimum floor.
Precisely. And while we're mostly talking about individuals today, just keep in mind this concept, this AMT idea, it also applies in different ways to corporations, trusts, and estates.
Gotcha. Okay, individuals are our focus. Now, you mentioned this like a parallel calculation.
Okay.
This is where my head starts to spin a bit.
Huh, yeah, it can feel that way.
This idea of alternative minimum taxable income, AMTI, it's not just adding a tax, it's like recalculating your income under different rules.
That parallel universe idea you mentioned earlier is actually pretty spot on. AMTI is basically a separate tax base. It's the starting point for figuring out if AMT applies to you.
Okay.
The good news, sort of, is you don't recalculate everything. A lot of your income and expenses are treated exactly the same for regular tax and for AMT.
Okay, that helps.
But, and this is the key, certain items get treated differently. Either the rules are different or the amounts you can deduct are different. And those differences are what create your AMTI.
Right. And these differences, I think you mentioned, fall into two buckets, adjustments and preferences.
Exactly right. Getting this distinction is like half the battle. So adjustments. Think of those mainly as timing differences.
Timing, how so?
Okay, imagine you have an expense, maybe research costs. For regular tax, you might write it off over, say, 5 years. But for AMT, the rules might say, nope, you got to stretch that over 10 years.
Ah, okay. So you get the deduction eventually, just slower for AMT.
Precisely. And because it's about timing, these adjustments can be positive in 1 year, increasing your AMTI, but then negative in a later year when the AMT deduction catches up or overtakes the regular one. They often sort of wash out over time.
Okay, adjustments, timing can go both ways. What about preferences?
Preferences are different. These are permanent differences. They represent things the regular tax code lets you deduct or exclude, but the AMT system basically says, that's too generous for our minimum tax calculation.
So it's taking back a benefit completely.
Pretty much. It's designed to claw back part, or sometimes all, of certain tax benefits. And crucially, preferences only ever increase your AMTI. They never make it smaller. They're permanent additions.
Got it. Adjustments, timing, can be plus MAT. Preferences, permanent, only plus MAT. That's clear. So after you wrestle with AMTI, what else goes into the mix?
Right, so you've got your AMTI, then you subtract an AMT exemption amount. And this is important. These exemptions are actually usually higher than the standard deduction for regular tax.
Oh, really? So that helps people avoid AMT.
Exactly. It shields a lot of people. After the exemption, you apply the AMT tax rates. For 2025, it's generally 26% on the first chunk, about $239,000 for most filers, and then 28% on anything above that.
Okay, simpler rates than regular tax.
Yeah, just two main brackets.
Yeah.
Then you figure in any applicable AMT credits, which gives you what's called a tentative minimum tax. And the final step is just comparing that tentative minimum tax to your regular tax liability. If the tentative minimum tax is higher,
You're on the hook for the difference. You pay the AMT.
you got it. You pay the higher amount, which effectively means paying your regular tax plus the AMT difference.
Okay. Let's dig back into those adjustments. You said they're about timing differences, bringing income closer to an economic picture. What are some common ones people run into?
Sure. So the basic idea is if your regular tax deduction for something is bigger than the AMT deduction allowed, that difference is a positive adjustment. It increases your AMPI.
Makes sense. More deduction, regular tax equals higher AMTI. Right. Or if some income is counted for AMT but not regular tax in a given year, that's also a positive adjustment. So depreciation is a classic example, especially on personal property, like business equipment.
Right. I remember hearing about that.
Historically, AMT depreciation was much slower. You had to use different methods, longer recovery periods. And this is a really important update for listeners with things like Section 179 expensing.
Where you can deduct the full cost of equipment right away, up to a limit.
Exactly, that big limit, like $1,250,000 for 2025. And also bonus depreciation or additional first-year depreciation for property qualifying for those, which is a lot of business investment these days. There's generally no AMT adjustment needed anymore.
Oh, wow. Okay, so that's less of a worry than it maybe used to be.
Much less of a worry for typical new equipment purchases. If you don't qualify for those or choose not to use them, then yes, you might still have an adjustment because the AMT might require, say, 150% declining balance method when regular tax uses 200%. But for many, it's a non-issue now.
Okay, good news on that front. What about real estate holdings?
Yeah, depreciation of real property. This used to be a huge AMT adjustment area. If you placed property in service, say, back in the 90s, before 1999,
Okay.
AMT required using much longer depreciation periods, like 40 years straight line versus the 27.5 or 39 years for regular tax. So your regular tax deduction would be bigger each year, creating a positive AMT adjustment.
Right.
We had an example in the materials. Kay's apartment building, regular depreciation was like $3,500, AMT was $2,400. Boom, $1,100 positive adjustment.
Large.
Another key update. For real property placed in service after 1998, the depreciation methods for regular tax and AMT are now generally the same. Straight line over the same period.
So no adjustment for newer buildings.
Correct. For most newer real estate investments, depreciation itself won't trigger an AMT adjustment. Big simplification there.
Okay, that's good to know.
Yeah.
What else? You mentioned research costs.
Right. Research and experimental expenditures, R&E. New rules kicked in recently, post-2021. For regular tax, you have to amortize these costs over 5 years. But for AMT, it's generally over 10 years, unless you're really hands-on, materially participating. So that mismatch, 5 years versus 10 years, creates an adjustment. Your regular tax deduction is higher up front, so it's a positive AMT adjustment.
Got it. Slower write-off, or AMT again now.
Yeah.
Incentive stock options, ISOs. These seem to come up all the time with AMT. What's the story there? That's spread.
Yes, ISOs are a classic AMT trap, or at least something you absolutely need to be aware of. Here's the tricky part. When you exercise an ISO...
You buy the stock at your special low price.
Right, for regular tax purposes.
Yeah.
Nothing happens at that moment. No income recognized. Zip.
Okay. Sounds good so far.
But for AMT, it's very different. In the year you exercise, if the stock rights are freely transferable or not subject to a substantial risk of forfeiture, basically, once you truly have the stock value.
Once it's really yours, not just an option.
Exactly. In that year, you have a positive AMT adjustment, and it equals the spread, the difference between the fair market value of the stock on the day you exercise and the price you actually paid for it.
Whoa. Okay, so even though you haven't sold the stock, haven't realized any cash, AMT says you had income.
AMT says you had economic income, yes. So we saw Bob's example. He exercised, the spread was $2,000. Bam, $2,000 positive AMT adjustment in 2025 when the stock vested, even though he didn't sell.
Okay. But that creates a weird situation with the stock's cost basis, right?
Absolutely. Your regular tax basis is just what you paid, your exercise price. But your AMT basis is higher. It's the exercise price plus that spread you already recognize for AMT.
So different basis amounts. Leading to
the other side of the timing difference. When you eventually sell that ISO stock, because your AMT basis is higher, your gain for AMT purposes will be smaller than your regular tax gain, or your AMT loss will be bigger.
So you get it back then?
Correct. This usually results in a negative AMT adjustment when you sell. In Bob's case, his regular tax gain was $3,000, but his AMT gain was only $1,000 because of that higher AMT basis. That $2,000 difference is a negative adjustment, offsetting the positive one from when he exercised.
So ISOs are a classic timing adjustment, potentially painful upfront for AMT, but it evens out at sale.
Generally, yes. Assuming you hold the stock long enough for capital gains, it balances out.
Okay. What about other adjustments? We've covered depreciation, R&E, ISOs. Anything else major, especially for itemized deductions?
Definitely. Well, first, just quickly, the adjusted gain or loss on selling any property can differ if prior AMT adjustments, like that depreciation difference on older property, affected its basis, and passive activity losses. The rules can be slightly different, sometimes leading to an adjustment.
Okay.
And there's a special alternative tax net operating loss deduction, 18 oldie. It's like a regular NOL, but calculated differently for AMT, and more limited can only offset 90% of your AMTI. Complex, but it exists.
Right, but the itemized deductions, that sounds like it hits a lot of people.
It really does. This is probably one of the biggest AMT triggers now, especially after the 2017 tax changes. The big one, state and local taxes.
The $10,000 cap.
Exactly. For regular tax, you can deduct your state and local income taxes or sales taxes plus property taxes, but only up to a combined total of $10,000 per household.
Right.
For AMT. That deduction is zero. It's completely disallowed when calculating AMTI.
Wow. Okay, so if you take the full $10,000 SALT deduction on your regular return,
you automatically have a $10,000 positive AMT adjustment, just like that.
So that example, Amy in high-tax state thinking moving would save tons on AMT. Maybe not as much as she thinks.
Probably not, because her positive AMT adjustment from SALT is already capped at $10,000 anyway, just like her regular tax deduction is. Moving might lower her regular tax, sure, but the AMT adjustment part related to SALT won't get any bigger than $10 for most people.
Interesting point. What about mortgage interest?
Qualified housing interest. It's mostly deductible for AMT too, but the definition is a bit stricter. It has to be interest on debt used to acquire, construct, or substantially improve your main home or second home that counts as a qualified dwelling.
So things like a home equity loan where you use the cash for something else. Maybe not deductible for AMT.
Correct. Or interest on a mortgage for, say, a third home, or maybe a boat that qualifies as a home for regular tax but not AMT. Or if you refinanced and pulled cash out beyond the original loan amount used for the house itself, those situations could create a positive AMT adjustment.
Oh, medical expenses.
Good news there. Medical expenses use the same floor, 7.5% of adjusted gross income, AGI, for both regular tax and AMT. So no adjustment required. That's straightforward.
And finally, the standard deduction.
Yes. If you take the standard deduction for your regular taxes, which many more people do now.
Right, since it's much higher.
You cannot take it for AMT. It's simply not allowed in the AMTI calculation. So while not an adjustment line item per se, it effectively increases your AMTI compared to your regular taxable income baseline because you start from AGI and then add back disallowed itemized deductions or don't get the standard deduction.
All right, it changes the starting math. Okay, that covers adjustments, the timing stuff. Now, what about those preferences, the permanent ones that always add to AMTI?
Yeah, preferences are less common for most individual taxpayers now, but they still exist, and they're designed specifically to take back certain tax breaks permanently for the AMT calculation.
Like what?
Well, one is percentage depletion. If you're in oil and gas or mining, and your depletion deduction calculated as a percentage of income is more than your actual cost basis in the property, that excess is an AMT preference.
Okay, specific to certain industries.
Yes. Same with intangible drilling costs, IDCs. For regular tax, you can often deduct these costs immediately. For AMT, a portion of that immediate deduction gets added back as a preference, essentially forcing a slower write-off for minimum tax purposes.
Okay, oil and gas again. Anything broader?
The main one that might hit more regular investors is interest on certain private activity bonds.
Muni bonds. I thought those were tax-free.
Generally, yes. Interest on most state and local government bonds is tax-free for regular tax. However, if the bond is classified as a private activity bond, meaning the proceeds are used primarily for non-governmental private business purposes, like maybe building a sports stadium or certain types of housing.
Okay.
That interest, while still tax-free for regular tax, is considered an AMT preference. It gets added back to your income when calculating AMTI.
So tax-free isn't always completely tax-free if you're in AMT territory.
Exactly. You really need to know if your muni bond is a private activity bond. Most aren't, but some are. Rachel's $18,000 in interest from those bonds. That's an $18,000 preference bumping up her AMTI. Though related expenses might offset some of it.
Good to know. Check the bond type. Any others? Small business stock.
Yeah, the exclusion for certain small business stock, QSBS. There used to be an AMT preference associated with this, but for stock acquired after September 27, 2010, the regular tax exclusion generally does not create an AMT preference anymore. So that's mostly good news for startup investors and employees.
Okay, so preferences seem a bit more targeted than adjustments these days. Now, with all this stuff potentially pushing you into AMT one year, maybe not the next, is there any way to get credit if you paid AMT?
Yes, thankfully. There's the AMT credit. This is really important for fairness.
Okay. How does it work?
Its purpose is basically to give you back AMT you paid that was caused by those timing differences, the adjustments we talked about.
Ah, only the timing ones, not the permanent preferences.
Precisely. The credit is generated only by AMT that arose from adjustments like depreciation, ISO exercises, R&E costs, things that are expected to reverse over time.
So things like the SALT deduction add back or that private activity bond interest,
Yeah.
those don't generate a credit.
Correct. Those are considered permanent differences, so no credit for AMT paid because of those items or because you use the standard deduction. The tax impact is permanent.
Okay, that's a critical distinction. So if you do generate a credit from timing differences, how do you use it?
You can only use the AMT credit in a future year when you are not paying AMT.
Okay, so it reduces your regular tax.
Yes, but only down to the point where your regular tax equals your tentative minimum tax for that year. Basically, it can reduce your regular tax liability, but not so much that it pushes you back into AMT for that year.
Got it. Can you carry it back?
No carrybacks allowed. But you can carry it forward indefinitely until it's used up, so it can be quite valuable over time if you bounce in and out of AMT due to timing issues.
Okay, a safety net, but only for certain types of AMT. Now, you mentioned briefly earlier that corporations have an AMT too. Anything quick we should know there?
Yeah, just a heads up. The rules we've been deep diving on are for individuals. Corporations had an AMT, then it was repealed, and now, thanks to the Inflation Reduction Act of 2022, there's a new corporate AMT.
Oh, really? Different structure?
Very different. It applies only to very large corporations, those with over $1 billion in average annual financial statement income over 3 years.
Financial statement income, not tax income.
Right. That's why it's often called a book minimum tax. It starts with the income reported to shareholders, applies various adjustments, and then imposes a 15% minimum tax on that adjusted financial statement income, AFSI.
Fascinating. So a whole different ballgame for big companies aimed at book profits.
Exactly. Just something to be aware of in the broader tax landscape.
Okay, so bringing it back to individuals. After absorbing all this, what are the practical takeaways? How can someone actually plan to minimize or avoid the AMT hit?
Planning is key, absolutely. Because once the year is over, it's often too late. One big area is managing those preferences and adjustments.
How so?
Well, think about investments. If you know you're likely to be subject to AMT, maybe investing heavily in private activity bonds isn't the best move, right? Because that interest is a preference item.
Right, it adds directly to AMTI.
You'd want to compare the after-tax return considering the AMT impact versus maybe a regular taxable bond or a non-private activity muni bond. Like Matt, our investor example, he needs to run those numbers.
Makes sense. What about deductions?
Well, recognizing which deductions are allowed for AMT is helpful. For instance, property taxes related to a business activity, like a Schedule C or a rental property on Schedule E, those are generally deductible for AMT.
Oh, unlike the personal property taxes capped at $10.
Exactly. It's the itemized deduction for state and local taxes that gets disallowed for AMT, not necessarily taxes deducted as a direct cost of doing business or generating rental income.
Interesting distinction. What about timing?
Controlling the timing can be powerful. Remember that AMT exemption? It shields a certain amount of AMTI. If you can, try to time income or deductions that trigger adjustments or preferences into years where you have room under the exemption.
Easier said than done, maybe, but worth thinking about.
Definitely. A more concrete timing strategy. If you expect to be an AMT this year, but maybe not next year, consider deferring your fourth quarter estimated state income tax payment until January. Because paying it in December adds to your state tax deduction for this year, creating that positive AMT adjustment this year when you're already paying AMT. You pay it in January, the deduction falls into next year, potentially when you're not paying AMT, so the adjustment doesn't hurt you or hurts less.
Clever. Shifting the adjustment to a non-AMT year.
Exactly. Little timing shifts like that can help.
Any other general strategies?
Sure. Things that reduce your adjusted gross income, AGI, generally also reduce your AMTI, which is good. So contributing to qualified retirement plans like a 401k or traditional IRA helps on both fronts.
Good old retirement savings.
Always a good idea. Also, be mindful of long-term capital gains. While they get favorable rates for both regular tax and AMT, a huge capital gain can significantly increase your AGI and AMTI.
Potentially pushing you over the threshold or phasing out your AMT exemption.
Right. It might phase out your exemption amount. So if you're close to AMT and have flexibility, you might consider spreading large gains over multiple years, if possible. But that's a complex decision involving market risk, too.
Definitely lots to consider. This has been incredibly helpful in demystifying the AMT. It's still complex, no doubt. But understanding the why, that fairness goal, and the mechanics of AMTI, adjustments, preferences, it makes it less of a black box.
Absolutely. It's not just for the super rich anymore. With the SALT cap especially, more high-income earners in certain states find themselves dealing with it.
Yeah.
And fundamentally, it reflects that ongoing balancing act in tax policy. How do you encourage certain behaviors with deductions and credits while still making sure everyone with significant economic means contributes a baseline amount?
Constant tension.
So maybe a final thought for our listeners, thinking about that core idea behind AMT ensuring a minimum level of contribution based on economic reality. What other area, maybe in our economy or financial system today, do you think could benefit from applying some kind of minimum principle to ensure fairness, and why?
Ooh, that's a good one to chew on. Definitely something to think about. Thank you so much for breaking all this down for us. And thanks to all of you for tuning into the deep dive. We'll catch you next time.